Hi, this is Phil Greenwood from the Wisconsin School of Business, University of Wisconsin-Madison. This is our next in a series of podcasts on financial statement analysis for the Wisconsin Entrepreneurial Bootcamp. What we want to discuss in this short podcast is ratio analysis, specifically aimed at looking at not just return on assets, but also breaking it into some components so that we can begin to see what's causing the change in return on assets. Recall that return on assets, net income divided by total assets in the company, is kind of a broad overview type ratio of how the company's doing. Now we want to break it down into detail to kind of see what's causing the change in ROA. Return on assets has two general components. It's comprised of the profit margin, and also it's comprised of asset efficiency. We'll see this in a second from a formula standpoint, but really what it's saying is that the change in return on assets can be influenced by the company either becoming more profitable in relation to its sales, or by managing its assets a little more efficiently in relation to the level of sales that it maintains. Mathematically, this is the ratio. Return on assets equals net income divided by sales, which we'll call profit margin, and net income divided by sales, or profit margin, times sales divided by total assets, or sales divided by total assets, also known as asset efficiency or asset turnover. What we want to focus on today is, in this section, is the net income divided by sales, or profit margin component of return on assets. Critical to why we want to understand this is we want to know, for instance, with Symantec, why did its ROA change from 1990 to 91? Was it due to profitability? Was it due to more efficient management of the assets, or kind of a combination of both? Recall that the Symantec income statement, and that's what when we talk about profit margin, we'll only be looking at the income statement. Recall that the revenue had grown significantly, the net revenues from 74 to 116 million. Gross profit followed that increase quite well. Operating costs, though, increased dramatically, especially the sales and marketing, research and development, and such, and resulted in not a very large increase in net income. Typically, one likes to see the percentage growth in net income or percentage increase in net income for each year to be the same or higher than the percentage increase than net revenues from year to year. So there's some questions that need to be asked, and I think the return on assets, knowing how that changed and now looking at the income statement, is going to provide some answers. So when we look at the Symantec profit margin, what we're going to be doing is taking their bottom line net income and simply dividing it by the sales or the total revenues for the year, or in this case the net revenues. So in this slide you can just see we'll take A divided by B, and it will create a percentage called the profit margin percentage. Other people call it operating margin percentage. There's a number of different names, but what it really says is that it gives you a sense for each dollar of revenues that the company is generating, or sales the company is generating, what percentage of that is making it to the bottom line in the form of profits available for the shareholders. Now again, recall the return on assets from our previous podcast when we calculated for 1990 was 19% or so, and that had declined significantly to 1991, 14.4%. Let's see if this same change occurred with the profit margin. When we plug in the numbers, the net income divided by revenues for both 90 and 91, you can see that the change in profit margin, the decline, was rather significant and correlates pretty closely to the decline in return on assets. So at least from this venue, or at least from this slide, one thing that you can kind of draw or conclude is a good portion of why our productivity measure ROA declined was simply because due to lower profitability. Our sales grew significantly, but our profits didn't keep up. Now, that's not necessarily a bad thing. As we'll talk about later when we talk about common size analysis, there might be reasons for we're making some bigger investments or expenses now that'll have some benefit many years in the future. But these are just kind of just raising flags for us to talk about. When we start looking at the profit margin, what we want to do now is begin to look at why, in a relative sense, especially from a ratio perspective, why the profit percentage declined in Symantec's example. What we're going to use is a term called common size analysis, where we literally take all the expense categories, each individual expense categories, and divide it by sales for the year and come up with a percentage. Very similar to what we just did with profit, net profits divided by sales. We'll also do the same thing for cost of goods, gross profit, R&D, and such. And hopefully it'll really highlight what are causing the changes in profitability in Symantec's case. So when we plug in those numbers, again rounding to the millions, one can see that in 1991, cost of goods sold was 20.8% of sales. Taking the 24.2 million divided by 116.3, which generated a gross profit of almost 79 cents. So for each dollar we sold, 79 cents was left over for profit to cover our selling, general administrative, R&D, and other operating expenses. When we look at our selling and selling general administrative, you can see in 1991 as a percentage that was 41% of revenues, R&D being 14.5 and the other being 10.6%. Our total operating expenses, adding those three together, was almost 68 cents of each dollar went toward covering those three categories. Now, a bigger question, not only is it telling us what is leading to our operating profit as a percentage of sales in 1991, but now when we convert 91 to percentages by common size analysis, we can do the same thing to 1990, so we can then compare the percentages. So when we look at 1990, you can see that in actuality, gross profit increased rather nicely from 76.2% up to 79.2% in 91. But that increase, which has a great impact, a positive impact for bottom line profits, that was offset by a dramatic increase in selling general administrative, which went from 38.9 to 41.1, and R&D went up 2.2 points. So in total, operating expenses increased 62.2% to almost 68%, which more than offset the positive increase from a percentage standpoint of gross profit. Now, when looking at this, one could say that's a bad trend, and generally that is, but maybe the company is launching a new product and they had a lot of marketing expenses, which would be much higher in 1991. Maybe the product was being launched in 91 or 92. Also, the company's investing more as a percentage of dollars of sales in R&D, which typically that's considered a good thing. So what this kind of analysis really does is it raises questions to help it doesn't have the answers, but it helps raise the questions that then you can begin to ask people in the company, in the organization, to obtain answers to why things are going the way they are.